Investing is often portrayed as a complex labyrinth filled with jargon, charts, and a myriad of strategies that can leave even seasoned investors feeling overwhelmed. However, at its core, investing is about making informed decisions with the intent of growing wealth over time. To navigate this labyrinth effectively, one must understand various investing strategies and the principles of financial planning that underpin them. At the heart of any successful investment strategy lies a clear understanding of one's financial goals. These goals can vary widely from person to person. Some may be saving for retirement, while others might aim to fund a child's education or purchase a home. Establishing these goals is the first step in crafting a personalized investment strategy. Once goals are set, the next phase involves assessing one's risk tolerance, which is essentially the degree of variability in investment returns that an individual is willing to withstand. Risk tolerance can be influenced by factors such as age, income, financial obligations, and personal comfort with uncertainty. With goals and risk tolerance established, investors can explore various strategies to align their investment choices with their financial aspirations. One of the most common strategies is the buy and hold approach. This strategy involves purchasing stocks or other assets and holding on to them for an extended period, regardless of market fluctuations. The rationale behind this approach is rooted in the belief that over time, markets tend to rise, and short-term volatility is less significant. This strategy is particularly appealing for those with a long investment horizon, as it allows them to ride out market downturns and benefit from the compounding effect of returns. Another popular strategy is dollar cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of the asset's price. This method reduces the impact of market volatility as it allows investors to buy more shares when prices are low and fewer shares when prices are high. Over time, this can lead to a lower average cost per share, which can enhance overall returns. Dollar cost averaging is particularly useful for investors who are just starting and may not have a large sum of money to invest all at once. It also instills a disciplined approach to investing as it encourages regular contributions to one's portfolio. For those who prefer a more hands-on approach, active investing might be appealing. This strategy involves frequently buying and selling assets with the aim of outperforming the market. Active investors often conduct extensive research, analyzing market trends, company performance, and economic indicators to make informed decisions. While this approach can lead to higher returns, it also comes with increased risks and often higher fees due to frequent trading. Active investing requires a significant time commitment and a deep understanding of market dynamics, making it more suitable for those with experience and a keen interest in financial markets. Conversely, passive investing has gained popularity in recent years, particularly with the rise of index funds and exchange-traded funds, ETFs. This strategy involves investing in a broad market index, such as the S&P 500, with the goal of matching its performance rather than trying to outperform it. Passive investing is characterized by lower fees and minimal trading activity, making it an attractive option for those who prefer a hands-off approach. Research has shown that, over the long term, many actively managed funds fail to outperform their benchmark indices, lending credence to the idea that a passive approach can be a smart choice for many investors. In addition to these strategies, diversification plays a crucial role in any investment plan. Diversification involves spreading investments across various asset classes, such as stocks, bonds, real estate, and commodities, to reduce risk. The idea is that different asset classes often respond differently to market conditions. When one sector is underperforming, another may be thriving. By diversifying a portfolio, investors can mitigate the impact of poor performance in any single investment, thereby enhancing overall stability and potential returns. Asset allocation is closely related to diversification and refers to the process of deciding how to distribute one's investment portfolio across different asset classes. The right asset allocation depends on an individual's financial goals, risk tolerance, and investment horizon. For instance, a younger investor with a long time until retirement may choose to allocate a larger portion of their portfolio to stocks, which historically offer higher returns but come with greater volatility. Conversely, an older investor nearing retirement may prioritize bonds or other fixed income investments to preserve capital and generate steady income. While developing an investment strategy is essential, it is equally important to regularly review and adjust one's portfolio. Market conditions, personal circumstances, and financial goals can change over time, necessitating periodic reassessment of one's investment strategy. Rebalancing or adjusting the proportions of different assets in a portfolio to maintain the desired asset allocation is a key aspect of this process. For example, if a particular asset class has performed exceptionally well, it may constitute a larger portion of the portfolio than originally intended. Rebalancing ensures that the portfolio remains aligned with the investor's risk tolerance and goals. Financial planning extends beyond just investing. It encompasses a holistic approach to managing one's financial life. This includes budgeting, saving, insurance, retirement planning, and estate planning. A well-rounded financial plan considers all aspects of an individual's financial situation and aims to create a roadmap for achieving long-term goals. Budgeting is a foundational element of financial planning, as it helps individuals track income and expenses, identify areas for savings, and allocate funds toward investment goals. Emergency funds are another critical component of financial planning. These funds provide a financial cushion in times of unexpected expenses, such as medical emergencies or job loss. Financial advisors typically recommend setting aside 3 to 6 months' worth of living expenses in a readily accessible account to ensure that individuals can weather financial storms without derailing their long-term investment strategies. Insurance is also a vital part of financial planning, as it protects individuals and their families from unforeseen risks. Life insurance, health insurance, and property insurance are just a few examples of the types of coverage that can safeguard against financial loss. By assessing potential risks and ensuring adequate coverage, individuals can mitigate the impact of unexpected events on their financial well-being. Retirement planning is another essential aspect of financial planning. It involves determining how much money one will need to maintain their desired lifestyle in retirement and developing a strategy to accumulate that amount. This often includes contributing to retirement accounts such as 401ks or IRAs, which offer tax advantages and can significantly enhance savings over time. Understanding the power of compound interest is crucial in retirement planning, as it illustrates how investments can grow exponentially over the years. Estate planning is the final piece of the financial planning puzzle. It involves preparing for the transfer of one's assets after death and ensuring that loved ones are taken care of. This can include creating wills, establishing trusts, and designating beneficiaries for various accounts. Proper estate planning not only provides peace of mind, but also helps minimize taxes and legal complications for heirs. In conclusion, investing and financial planning are intertwined disciplines that require careful consideration and strategic thinking. By establishing clear financial goals, assessing risk tolerance, and exploring various investment strategies, individuals can create a tailored approach to growing their wealth. Diversification, asset allocation, and regular portfolio reviews are essential components of a successful investment strategy. Simultaneously, a comprehensive financial plan that encompasses budgeting, saving, insurance, retirement planning, and estate planning provides a solid foundation for achieving long-term financial security. Ultimately, the journey of investing and financial planning is not just about accumulating wealth. It is about creating a life of financial independence and security, allowing individuals to pursue their passions and dreams without the burden of financial stress.